Today we're analyzing Alexandria Real Estate, ticker ARE. Alexandria might not be a household name, but behind the scenes it owns some of the most advanced lab and life science real estate in the world. With a 12 billion market cap and clients like Moderna and Pfizer, this REIT plays a vital role in supporting innovation. But right now, the stock is beating down for a reason, trading at under 8 times its FFO, with a generous 7.3% dividend yield. Is it a value trap or an overlooked opportunity hiding in plain sight? Let's find out. Overview. Alexandria isn't your typical REIT. It specializes in owning and developing life science campuses. Think advanced lab space, research parks, and biotech hubs. These buildings aren't just generic offices. They are mission-critical facilities, purpose-built for scientific research and development. The company operates over 70 million square feet of space, mostly in innovation-dense markets like Boston, San Diego, and the San Francisco Bay Area. Its tenants include major names in biotech, pharma, and academia. Companies that literally change lives. And here's something interesting. Because of the sensitivity and of the proprietary nature of the work being done, like drug development and gene editing, many of these employees can't just work remotely. Unlike traditional office jobs that now allow hybrid or fully remote work, researchers and lab staff need to be on site, using equipment and working in secure, specialized environments. That makes Alexandria's properties more essential than many office REITs, and that could be a long-term advantage in a work-from-anywhere world. Financials. Now let's look at the numbers. Alexandria's current FFO is at $9.21, and the stock is trading just below 8 times its FFO, well below historical averages. It pays an annual dividend about $5.20, offering a high yield of roughly 7.3%. The payout is well covered with the payout ratio in the 55 to 60% range. Short interest has risen to about 3.4%, so there is some bearish sentiment in the market but nothing alarming. In terms of long-term performance, the total returns in 1 year are a superb minus 35%, and in 5 years returns are minus 50%. But let's not get too hung on the past, because I still think they have a semi-bright future. Alexandria's revenues and revenues per share have been growing almost non-stop for a decade. FFO has been growing for the past 5 years with little ups and downs. AFFO has only been growing in the same period. On paper, the company seems good and cheap. Now let's look at the future and why the stock is down. Future. Let's start with the opportunities. There's a lot to like about Alexandria. First, it operates a niche real estate sector that's not easily disrupted. Lab space isn't something you can just convert from a regular office. It requires specialized infrastructure, high safety standards, and proximity to research clusters and talent. And because of the hands-on and often confidential nature of life science work, most tenants must be there physically present. That makes these properties more resilient in the world where remote work is eroding traditional office demand. Alexandria also benefits from long-term leases, a well-established reputation in the biotech ecosystem, and locations in cities with high barriers to new development. These factors give the company pricing power and a degree of isolation from typical REIT headwinds. Let's move on to the risks. That said, there are some real reasons why the stock has sold off. Shares of Alexandria have dropped sharply in the recent years, mainly due to a combination of high interest rates, reduced biotech funding, and investors' fears around office real estate in general. Even though Alexandria isn't exposed to traditional office tenants, it is still being lumped in with that sector. Add that to the rising cost of capital, REITs rely heavily on debt, and suddenly even great properties start to look less attractive to investors. Another concern is the elevated amount of space under development. While it creates growth potential, it also carries risks. especially if tenant demands weakens and projects face delays. Lastly, I think one of the biggest reasons Alexandria Real Estate is down right now is due to the concerns that the funding from the National Institute of Health (NIH) could be cut. The US government has been discussing potential reductions to the NIH budget, which creates uncertainty for the life science sector as a whole. To give you a sense of scale, the NIH provides around 80% of the world's public funding for biomedical research. In total, it distributes approximately 39 billion per year from its around 48 billion budget. That funding is granted to universities, research labs, and biotech companies. These are not private sector spending, but this has a spillover effect. Let's try to size the market impact. Alexandria is a 12 billion market cap company, but its tenants are giants. The top 5 alone represent companies worth nearly $1 trillion, and their combined R&D budgets around 36 billion USD. If we include the top 10, the number likely doubles. So to speculate, somewhere in the 70 to 130 billion range just in the R&D spending by Alexandria's tenants. Broader estimates for total US life sciences R&D spending range from 100 to 250 billion, depending on what's included. For comparison, Alexandria collects about 3 billion in annual rent, backed by a long-term leases averaging around 8 years. So what happens if NIH funding gets cut? Estimating these cuts' effect on Alexandria is like picking a winner of a horse race based on a fortune cookie. Wildly speculative, but kinda fun. These numbers are huge, the variables keep changing, and nothing is certain. But hey, let's give it a shot for science, curiosity, and because let's be honest, we all enjoy a bit of financial fortune telling. So Trump proposed a 40% cut to the NIH's budget, so roughly 17 billion in funding terms. That is huge. But how would this realistically impact Alexandria? This could impact Alexandria in 2 ways, either through tenant bankruptcies or by tenants choosing not to renew their leases. Let's try a rough speculative model. Say let's 20% of Alexandria's tenants are smaller, more vulnerable biotech firms. If 8% of those went bankrupt due to funding issues, that would mean a 1.6% hit on the revenue. Now for the lease renewals. If US life sciences funding fell from 170 to 154 billion, a 12% decline, and we assume that this leads to 60% proportional decline in demand for space, that would represent about 7.2% potential revenue impact, but spread across an 8-year lease cycle, so less than 1% per year. Combined, we might be looking at a total impact of around 2.6% to annual revenue, and the rest is spread over several years. And again, very speculative numbers. You could easily adjust the assumptions and get different results. In my view, the growth of the life sciences industry as a whole will likely outpace any funding cuts, at least when it comes to rent. Even if NIH trims its budget, the long-term demand for lab space, private R&D, and biotech innovation is strong. Don't get me wrong, this will definitely impact Alexandria's rent, if these cuts are coming, but to what extent, I'm not sure. But I'm curious to hear your thoughts. Are my assumptions too optimistic? Am I missing something critical? Let me know in the comments. But in short, Alexandria is a great business in a misunderstood category, but not without its own challenges. Let's move on to the intrinsic value. Let's try to estimate Alexandria's intrinsic value. Alexandria has a FFO of $9.21. In the short term, analysts are not expecting much growth from Alexandria. And I agree. I would estimate 1% growth for the next 5 years and 4% growth for the next 5 years. Historically, Alexandria has traded with a P/FFO ratio between 15 and 20, but today it sits just under 8. I want to stay cautious, so let's assume a fair multiple of 12. And as always, I want 12% for my money. With these numbers, my estimated intrinsic value lands around $100 per share. At today's prices, Alexandria seems significantly undervalued. But of course, that assumes rates don't go much higher, that the demand for lab space holds up, and possible funding cuts doesn't affect rent too much. So, is Alexandria a screaming buy? Honestly, I like the company. I think it owns high-quality assets in an irreplaceable niche. My only concern is the possible funding cuts to biotech. The cuts haven't happened yet, and the impact of these cuts to Alexandria are a bit uncertain. So for now, I just keep holding the company but not buying more. I have a quite large stake on Alexandria, but if I wouldn't own it right now, I think I would buy some. Even though the analysts are not expecting much growth, with the P/FFO ratio under 8 and with a high 7% dividend yield, I can be patient for a long time. And as always, this is not financial advice, just one investor's opinion. Do your own research. Let me know what you think in the comments and hit the subscribe button and like. And as always, do not lose money and safe travels. Bye bye.